Hi, my name is Katrina Lyons, and I'll be explaining improper asset valuation to you along with my associates Guy Han and Kristen Bishop. In order to understand improper asset valuation, you have to first understand what financial statement fraud is because it's a part of financial statement fraud. Financial statement fraud is the intentional misrepresentation of the company's financial position through deliberate misstatement or omission of amounts, disclosures in the financial statements to deceive its users. What are financial statements? Financial statements consist of the balance sheet, the income statement, and the cash flow statement. The balance sheet is a snapshot of the company's financial position at a given point in time and is comprised of the equation assets equals liabilities plus equity and is prepared at the end of the fiscal year. The income statement shows net income or loss through a period of time through its revenues and expenses, while the cash flow statement shows movement of cash through the company during that fiscal period. Financial statement fraud is usually committed by top management because of their access to the accounting functions and their ability to override internal controls. Financial statement fraud consists of double entries. So this means that when one account is affected, another account is affected to that journal entry. How is it committed? It happens through the manipulation, falsification, or alteration of accounting records through supporting documents that consist of invoices, receipts, and other documents. This can be done by falsifying an invoice, changing the numbers on an invoice, or completely omitting an invoice. Next is a misrepresentation or intentional omission of important events that affect the company's operations. This could be avoiding transactions or not talking about litigation happening during a lawsuit or a warehouse fire or a pandemic, or some type of event that's going to affect the operations of the company. Lastly is the intentional misapplication of accounting principles. This could be changing an inventory method from first in, first out to last in, first out without a justification or disclosing it. When financial statement fraud happens, 3 points on the triangle of fraud are committed. That's incentive, opportunity, and rationalization. Incentive is some type of motivator that makes top management feel like they need to commit this fraud. This could be trying to meet Wall Street analyst expectations, trying to hide bad news, meet short-term expectations. They might be trying to acquire financing for the company, attract investors, or a purchaser of the company. By trying to inflate assets to make it look better, they'll commit fraud. Opportunity is important because top management has the opportunity because they have access to the accounting functions or overriding internal controls. And then rationalization can be something like the company's culture where they feel like they can commit fraud because they have some bigger purpose that they're trying to meet, that they're trying to focus on a bigger mission, denial of responsibility, or dehumanizing victims. Examples of financial statement fraud. Financial statement fraud is usually asset revenue overstatement or asset revenue understatement. Improper asset valuation is the overstatement of assets and revenue. It exaggerates the company's assets and portrays the assets in a more positive financial light called window dressing. It'll inflate current assets at the expense of long-term assets to falsely improve the financial ratios. This could be the current ratio, the quick ratio, or earnings per share to attract investors, and requires direct access to accounting functions. The most common form is overstating inventory and accounts receivable, which we'll discuss further in the presentation. Why would a company or why would management choose improper asset valuation as the scheme that they want to commit? Mostly like acquiring financing for the company to inflate assets. Maybe bankers require certain assets on the statements, manipulating ratios to attract shareholders or investors, increasing net income to show that they're successful at the company's purpose or operations, and to present a financially strong company through fictitious assets or revenue, which will increase net worth and equity. So how does it affect the financial statements specifically? With the balance sheet, it'll increase assets, which will increase equity. And then on the income statement, it will increase net income by inflating revenue through less cost of goods sold. Now my associate Guy Han will explain accounts receivable related fraud.
Well, I will explain about the accounts receivable related fraud. Accounts receivable is a balance of money due to a company for goods or services delivered or provided, but not yet paid. When a credit sales occur, a company recognizes the sales by debiting accounts receivable and crediting sales. After that, if a company gets paid, the company records the receipts by debiting cash and crediting accounts receivable. Next. However, if a certain accounts receivable is expected not to be retrieved, a company should recognize this amount as allowance for doubtful accounts. To provide more credible information to information users, generally accepted accounting principle requires a company to recognize expenses incurred during a period to be recorded in the same period in which the related revenues are earned. This is called matching principle. Next. The company chooses the method for the allowance at first, and then choose a base for the allowance from either sales amount or accounts receivable amount. And then, after finding a certain percentage not to be retrieved, apply the percentage on the selected base for the allowance. Finally, record it by debiting bad debt expenses and crediting allowance for doubtful accounts. However, because it is calculated based on estimate, sometimes it could be misused for financial statement fraud. From now on, I will explain about some examples of fraud related to the accounts receivable. The first example is a fictitious accounts receivable. By overstating accounts receivable, the company could pretend that they are capable to generate enough cash on their own. This fraud is occurred commonly at the end of the accounting period. To accomplish their goal, could you go back? Thank you. To accomplish their goal for the sales settled at the beginning of the year, the company normally tries to do their best. However, if the management does not expect to accomplish their goal at the end of the period, risk for the fraud increased. Could you go to the next slide? Then, how to prevent and detect this fraud? This could be done by both management and auditors. The methods I will explain from now on can be used by both management and auditor. The first method is the accounts receivable confirmation. Accounts receivable confirmation is a process to send a confirmation to a customer to verify whether an accounts receivable amount is right. Secondly, inspecting documents from purchase order to invoices and shipping documents could help to detect a fraud. When a sale occurred, certain documents related to the sales are received and generated. By inspecting those documents, a fraud could be caught. The third thing is a subsequent period test. Generally, audit is performed after the book for the fiscal year closed, and because usually payment term for the invoices are 30 days, 60 days, or 90 days, which is during the account period, some of receivables could be checked whether to actually adjust it or received or not. If there is an unmatched record to the audit process, because it could be a red flag, internal or external auditor should take a look in more detail. The second example of accounts receivable related fraud is a failure to write down. As I mentioned before, FASB requires the company to accrue losses on uncollectible receivables. However, sometimes the company changes their estimated percentage for allowance unreasonably. If a company decreased their estimated percentage from 5% to 2% without any special reason, it could be a red flag and the auditor should take a look in detail. Also, sometimes the company did not write down an outdated accounts receivable. They could manipulate accounts receivable aging report to validate their assertion not to record allowance. Could you go to the next slide? To prevent and detect this fraud, management and auditors could use the following methods. The first method is to perform analytical procedures to find any unusual factors and inquire if any unusual factor exists. By interviewing employees, sometimes internal or external auditor could find a red flag. The second thing is to perform subsequent period test for sales and sales adjustments. By testing any adjusted sales without any valid reason, internal or external auditor could detect this fraud. The third thing is to observe authorization process for writing down. Accounts receivable writing down issue is closely related to authorization process in internal control. By observing authorization process for writing down, internal or external auditor could detect this fraud. Also, we could help to detect this fraud to perform regularly performance review to verify whether the authorization process is working in the right way.
So first, we need to figure out what inventory actually is. So basically, it's just anything that a company buys to sell later. So that can be shoes for Foot Locker, ice cream from Baskin Robbins, TVs from Best Buy, basically anything that a company buys to sell later. So now that we know that, how does the scheme take place? Well, one of the simplest ways is just by MMS count. If an employee making a physical inventory account counts inventory that's not exactly there, which is what we call phantom inventory, that would increase the amount of inventory, the value of it, which would be improperly valuing it. Another way is inflating the cost. So say we buy a TV for $100 and we sell it for $200, but instead of saying that we bought it for $100, we say we bought it for $200 and that we're going to sell it for $300. So saying that we bought it for more than we actually did would be valuing it incorrectly and is not allowed. Another way is failing to devalue it. So going back to our example, if we bought TV for 100, but say due to the way the market's working or a decrease in popularity of TVs, the value of them goes down. So instead of them being valued at 100, they're only valued at 50. So in our books, we'd have to record that loss of 50. But if we continue to say that the TV is worth 100, when really it's only worth 50, that would be improperly valuing it and would be a misleading kind of piece shown there. So who does it? That can be many different people, from the employees on the floor actually taking the physical counts of inventory, to the supervisors that overlook those activities, all the way up to the highest ranking officials of the company, basically anyone who has direct contact with inventory procedures or anyone that can have influence over those people that have those positions. So what are the red flags? You can compare the company in question to others within the industry. So for example, if we're looking at Foot Locker, if we look at other companies within that industry and we see that their inventory usually is pretty low, and then for some reason this company has large amounts of inventory, that could be a red flag. Another one is the relationship to the market. So going back to what we said, if we say that the TV was worth 100, but now it's only worth 50, we would expect to see that reflected in the statements. But if we see that the company's inventory, like valuation, is going down, but on their books, inventory is still the same or it's going up, that could be a potential red flag too. And even just comparing the company against its own historical data. So if we see that in prior years, inventory only changes around like 5 or 6 units or so, and then for some reason this year it changed by 100, that could be a potential concern that we might want to look into. So how can we detect it? Just a few ways: using analysis. Like we said before, comparing it to its prior years, that could be a way to see, potentially detect a fraud that's going on. We could also do an actual inspection of the accounts, seeing if any accounts in inventory are larger than they have been in prior years, or if they just seem abnormally different. That could be one way to detect the potential fraud. And even just take our own count of inventory. If we go in and say that we make a count of 200 units, but the company claims that they have 300, that 100 difference might be a potential reason to look into it further. And how can we deter the scheme? Well, there's a few ways, just to name a few. You could foster an environment of surveillance. If an employee feels as though that their activities are being monitored or they're being surveyed, they may be less likely to partake in those activities if they feel like there's a high risk of getting caught. Another way is to make employees aware of the policies in place. So if an employee is aware of the punishments and repercussions from engaging in those acts, they may feel less inclined to do so since they know of the consequences that go along with it. And even just a simple separation of duties. So the person that makes the initial count of inventory shouldn't be the same person that does the recount. So kind of separating those kind of two responsibilities would make it harder for anyone who wants to improperly value inventory to do so by themselves. They would need to get other people involved. So that would be, it would make it harder for them to kind of act this way. And back to you, Katrina.
Thanks, Tristan. Okay, so key takeaways are that the financial statement fraud involves increases or decreases in assets and revenue. All frauds will meet the fraud triangle. Multiple schemes are usually used in fraud. And that improper asset valuation will increase assets and revenue, creating a better financial position for the company. And the two most common improper asset valuations are inventory and accounts receivable schemes. And it's important to deter and detect through culture training, audits, and analytics. Thank you. And if you have any questions, we can be reached at the emails below.